All right, good evening, everyone. Welcome again to the Women Managing the Farm Financial Series. We're on session 2, as I'm sure you know. Again, I'm Robin Reed from the Agricultural Economics Department here at K-State.
And I'm Lavelle Windsor. I'm one of the farm analysts with K-State.
And I'm going to start sharing our PowerPoint here. So welcome again. As I said, we are on the balance sheet. Last time, hopefully you were here with us. We talked about keeping quality farm records. Now we're into the balance sheet, and from there we're going to go on to the income statement and the cash flow. So hopefully you had dinner at this point. That started at 5:30. Just to kind of give you a little outline of what we're going to do tonight, because this is kind of starting our normal format. Last time we had a lot of discussion and things going, presentations going on. So we're going to do a bit of a presentation on the balance sheet, turn you loose on an activity just to drive home what we are teaching tonight. And then you're going to have a local presentation that is featuring this as a different stress. As we're talking about farm financials, we know there is a lot of anxiety and stress over this topic. So we are going to address that tonight. And again, our goal really is to provide resources that you can take back home to your farm and build upon your current financial structure. So, as we're going to talk about tonight, balance sheet is a way to assess your financial position at a single point in time. And then when you're looking at your balance sheets over time, looking at the change in your net worth and what that can tell you about your financial position and the financial health of your farm. As we start discussing the balance sheet, there is a publication in your packet if you want to pull that out along with our presentation slides. You're welcome to follow along with that as well. It just gives you a picture of what the balance sheet looks like and an outline as we're discussing the topic.
So we're going to go ahead and get started with the balance sheet. And we did hear a little feedback last week that some people were really happy with kind of the groundwork that we laid. And that was really part of the goal last week, was to lay the groundwork. And now we're going to start with getting some activities going with this session and hopefully give you some hands-on work that you can do for your own farm. So we're going to talk about a balance sheet tonight. Many of you are probably making your balance sheets right now with your lender. It's a pretty common activity that you do on your farm in the month of January to get ready for a new line of credit for next month. So we are, what is the balance sheet? The balance sheet, it is a snapshot in time. So it's going to give you an overall financial picture of your business. So it is a way that you can organize what is owned and who do you owe in your business. So it provides a snapshot in time. So if you do a balance sheet today, it's going to look slightly different than your balance sheet is going to look in a month from now. That is one reason that we recommend to do your balance sheet at the same time each year. I mentioned last month that I try to do my balance sheet every year on the 1st of January and capture all of that detail at that time. It is the fundamental to sound business decision making. And when I'm working with the family farm, it tends to be the very first thing that I ask for if we're going to talk about anything financial, because it just gives you that nice overall picture of what's going on with the operation. So it is a measurement of financial success. It's not the whole entire picture, but it's definitely a building block in that. And it's a way that you can communicate your financial position to your creditors. It is going to be something that your lender is going to ask for. So when we look at what is on the balance sheet, we're going to have all of the assets are going to be listed. So that's everything that the farm owns. So examples of that will be the farm checking account, grain that you have in storage either at the elevator or on your farm. If you have any livestock, equipment, land, all of those are examples of assets. And then on the flip side of that, who you owe, what are the liabilities? So any debt obligations that you have, that might be operating notes or like your line of credit. It might be outstanding accounts payables. Maybe you have a carryover fuel bill that you've received the invoice for, but you have not made the payment on yet. It can be loans on your machinery, cattle, land. It may also be credit card debt. Those are the types of things that fall under that liability category. And then you get down to the bottom and we have owner's equity, or net. Another way to say owner's equity is net worth. So that is assets minus liabilities. So it's just subtracting the two. And so it's that bottom line number that we're looking for. Just a reminder, or just another terminology, sometimes the balance sheet is referred to as the net worth statement. So you'll hear those terms used interchangeably. So let's take a look at what is on dig into a little bit more of what exactly is on the balance sheet. So current assets are anything that can be converted to cash quickly. We call current assets anything that can be converted to cash within a year or is intended to be converted to cash within a year. So that could be cash, accounts receivable. Accounts receivable is maybe somebody who owes you money for something that you did for them, or at the end of the year, a common one is maybe you defer payment till the next year. That would be an accounts receivable. You would classify that as an accounts receivable on your balance sheet. Fertilizer, seed, anything prepaid or supplies on hand. Maybe you have some fuel in the fuel tank carried over. That would be a supply on hand. Investment in growing crops. Maybe, for example, if you have wheat planted and you've got the seed, you have the fertilizer. Maybe there's been some fertilizer applied. That would be investment in growing crops held for sale, and then market livestock would be calves on the ground, for example. Non-current assets are going to be those things that are not as easily to convert into cash, and usually those are things that are going to support the farm production. So non-current assets for intermediate would be, most farms, it's going to be things like breeding livestock or machinery and equipment. And long-term assets are most often going to be land or buildings. Investment in cooperatives, that would be a place that you would put it under a long-term asset. So let's talk a little bit about the structure of debt. So current is going to be 1 year or less. So it doesn't take long for that a growing season to go by being 1 year. So an example of current would be the line of credit. That is going to be due annually. Intermediate is going to be something that has a lifespan of 2 to 7 years. So machinery and equipment and breeding livestock, that's where those fall. Long-term is going to be something that has a longer term of a lifespan than just 7 years. So real estate and buildings and improvements will tend to be the pieces that go under long-term. So let's switch over. We just talked about the asset side. So now let's switch over to the less fun side of the balance sheet, and we'll talk about the current liabilities. So again, current being any one that you owe or you're going to have to pay within 1 year. So accounts payable would be an example. They're almost always, most balance sheets will have some amount of accounts payable that are outstanding. Any accrued expenses. Taxes payable. Right now, a lot of you are probably doing some tax preparation. Some of you, we may not have quite completed our taxes yet, but if you know what those are outstanding, that would be a place that you would record them as under current liabilities because they're going to be due. The current loans that are due, so again, those lines of credit, maybe that is if you finance your seed directly with the seed company or maybe directly with your ag retailer or your co-op, that's where those that would fall under the current loans. current portion of term debt. So that would be, like, for example, if you have a land loan, the principal that's due on that land loan would be moved up to that part is going to be due within the next year. And then any accrued interest. So for example, if you're making a January 1st balance sheet, let's say that you have a land loan that is due on March 1st, and it's an annual payment. You're going to, from last March, you would have accrued 9 months worth of interest from March 1st until January 1st. And so you would put that accrued interest under the current liabilities. Moving over to the non-current liabilities, this would be intermediate loans. So loans on breeding stock or machinery is typically what's going to fall in that category for farming. And then long-term loans are most often are going to be land loans. Perhaps there's a loan on a building that you've put up. And then deferred taxes should go on your balance sheet. If you ask me how many balance sheets I see that have deferred taxes listed on there, I won't say it's 0, but it's probably like 1%, not very many. But we really should recognize deferred taxes on our balance sheets. Most people do not, and I'm not sure if I've ever seen a banker that's required that to be accounted for. So let's go over to let's take a look at what a balance sheet would actually look like. For the sake of you being able to see this balance sheet or have a better chance of seeing this balance sheet, I broke it up into a couple of windows. Normally I would work all the way down the left-hand side with the assets and then all the way down the right side with the liabilities, but we're just going to focus on the current portion and then work our way down. So you can see that balance sheet. We have current assets listed up there. We have cash and checking, supplies, growing crops, accounts receivables, crops on hand, and all of those things get added together, and we have a total current asset value on this balance sheet of $451,760. Now you will notice there are places that it says some schedules. So an example would be up there under prepaid supplies. There is a schedule that's attached to it. That would be something that we'd recommend as you are creating your own balance sheet is maybe your farm typically prepays some seed and maybe a little fertilizer. So keeping track of that behind the scenes in a schedule is a good way to do that so that you know what all the detail is behind the scenes on it. Now let's switch over to the right-hand side of the balance sheet, and there we have the current liabilities. So you'll see that accrued interest, the interest that is due on some loans, if they were going to make that payment right at that time. Any accounts payable. Accounts payable is another nice one to keep a schedule behind the scenes so you know what those payables actually were. This farm has a line of credit through a bank, and then it also has a seed note as well. And then it also has principal that is going to be due on the long-term notes, the principal portion that's going to be due in the next 12 months. So in this instance, we have current liabilities of $708,394. Some of you may be saying, that doesn't look right. And you're correct, and we're going to talk about that here in just a moment. But for the time being, we're going to just keep working our way down this balance sheet, and then we'll come back and talk about that. So we next go down on the left-hand side, and we see the intermediate assets. This farm only has machinery and equipment in this example. We don't have any breeding stock, so all of their intermediate assets are their machinery and equipment of about $1.3 million. Under the long-term assets, they have 3 parcels of land. Each parcel, I encourage people to value each parcel individually because land different parcels of land have different valuations. And then they also have some buildings and some other long-term assets as well. All of the long-term assets together add up to just over $1.3 million in this example. Switching over to the liability side, this farm has a machinery loan that is an intermediate balance of $320,000. And then they have two long-term loans, one for a farm loan and another one for a hay shed. And those total long-term liabilities add up to $281,000. So then we get down here to the bottom. All of those farm assets, the current assets plus the intermediate assets plus the long-term assets, comes up to just over $1.3 million for this farm. The total farm liabilities, again, current, intermediate plus long-term liabilities, adds up to about 1.3 million. And then if we subtract total farm assets of 3.1 million minus total farm liabilities of 1.3 million, we get to a total net worth of 1.8 million in this balance sheet. So, whoops, before I go there, something I want you to think about is this a good number? And that's going to be that's going to lead right into our next place. We're going to start to analyze the balance sheet and what does this balance sheet look like?
Okay, so there's a couple terms that we talk about with the balance sheet. One is liquidity and one is solvency. And I'm going to go through exactly what those mean and how you evaluate those when you look at your balance sheet. So liquidity is just looking at the current assets and the current liabilities. As Lavelle just covered, that's anything that can be converted quickly to cash within a year's time on the asset side, or on the liability side, anything that's due within a year's time. So obviously you want to have at least $1 of current assets to cover every dollar of current liabilities that you need to pay in the coming year. Now let's go back and look at that balance sheet that she just presented and take a look at that debt structure. So over here, we have total current assets of $451,760, and we have total current liabilities of $708,394. Now, if we divide those current assets by those current liabilities, we come up with 0.64. So that means we have 64 cents of assets for every dollar of current liabilities that we need to pay in this next year. That is quite problematic. Now, what would be a good number? One thing that I developed here a few years ago was a benchmarking tool. And what this does is lets you compare what your financial ratios are with other farms in Kansas. So the one I have up here is just a summary for the entire state and all of the farms that are in the Kansas Farm Management Association. But know that you can go to agmanager.info/decision tools. It's on the bottom of your slide here. And you can pull this spreadsheet up and look at different regions of the state, different sizes of farms, the operator age of principal operator of the farm, and actually narrow this down to a set of farms that most closely matches your own farm. So how do we look at benchmarking this graph? And again, benchmarking is just comparing how your operation is doing with other similar operations and saying, am I doing well or am I doing poorly compared to other farms like me? Now, what this shows in the blue shaded area is a 10-year average of the KFMA farm's current ratio. You can see that there's a bit of a hump over 1.5, so that would be $1.50 of current assets for every dollar of current liabilities that they have. And there's a large spike greater than 4. We have a number of farms out there that have more than $4 of current assets for every dollar of current liabilities that they have. Or there's some that are actually close to infinity, meaning they don't have any current liabilities to match with their current assets. So we have a lot of farms that are in a very strong position when it comes to their current ratio. But look at the orange bar in comparison. This is the distribution of the current ratio for KFMA farms in 2018. You can see the difference between that and the blue shaded area. 2018 is the last set of data that we have. We won't get 2019 for another few months here. But you can see there's been a spike in the amount of farms that have a current ratio of 1.5 or less. So by looking also at the red, yellow, and green bar below, you can assess what's a strong financial position. Anything, getting to $1 or less is a vulnerable position. That means you're going to be coming up short and paying your current liability. Anything up to considered a strong position. So looking at this, our farm of 0.64 is obviously a vulnerable position, and at the very end of the distribution, as far as looking at other farms that have a current ratio in that range. So we would say this farm is definitely struggling with its liquidity. Now the next thing to look at is solvency. So when you think of solvency, instead of thinking of just the current picture of current assets and current liabilities, this is looking at the entire picture. So all of the assets added together, current and long-term, all of the liabilities added together, current liabilities and long-term liabilities. So we look at solvency as an entire measure of how many assets the farm has versus how much debt or liabilities the farm has. So the typical measure that we look at to do this is called the debt to asset ratio. So what that does, again, is just taking total liabilities on the balance sheet divided by total assets on the balance sheet, looking those bottom line numbers and dividing them. So this number can help us know the overall debt picture. Are we in a place to expand? Are we in a place to take on risk in our operation? How much of our debt, how much of our business is owed to creditors? How much is debt? And it just gives really an overall picture of the operation. So let me just give you an example here just to help you kind of drive this point home here. So our total farm assets on this farm were just over 3.1 million. Our total liabilities about 1.3 million. If we divide those two out, we get 0.42. So 42% of your assets are actually owed by creditors. Now, just a note here, when we're looking at those numbers and we're looking at net worth, just a note, we do talk about net worth as what is owned outright in the farming operation. If you paid off all your debt today, what would you have left? One caveat to that is some tax consequences. If we actually did liquidate all the farm assets today, we wouldn't have the exact balance sheet value that is listed, because there's probably, just to give you an example here, if we sold some land now, it probably appreciated in value versus the basis that we have in that land. So if we sold it today, we would be paying some capital gains taxes. So that's getting down in the weeds a little bit, but just know as we're talking about that tax liability, what that means. Okay, so going back to our 42%, is 42% of your assets owed to creditors? Is that a good number? Well, again, I'm going to go back to the farm financial benchmarking tool. And so this is the same set of farms now all across Kansas, Kansas Farm Management Association farms, looking at the debt to asset ratio. Again, the whole picture. The blue is a 10-year average and the orange is 2018. You can see by the colors below, generally a strong position is 30% or less of your debt owed to creditors. So your debt to asset ratio less than 30%. If you get above 60%, this is really where you're getting in a vulnerable position where you don't have a whole lot of Equity, you don't have a lot of flexibility to do any expansions or manage risk because a lot of your assets are owed to creditors. This is also where we get worried in the downturn in the farm economy like we're in now. If we would start losing value on our land, you can see how that would affect the balance sheet. All of a sudden our asset values going down where our liability values are staying the same. Even without changing anything on your operation, that debt to asset ratio would be going up just because the asset value is less. Now, on our farm of 42% here, you can see that's kind of in the middle. A number of our KFMA farms are better than that, so have a lower ratio than that, but there also is a fair amount of our farms that are greater than that.
Okay, so we're going to switch over now and talk a little bit about some pieces around completing the balance sheet. So some tips that I would encourage you to consider is, first of all, is preparing your balance sheet at the same time each year. This is really important because if you prepare at the same time each year, then you can, once you start doing that, then when you have some historical data, you can start to compare year to year to year. What does, what is the growth of your business, or is it regressing? So but it gives you some trend ability to look at. So, and also focus on completeness. And I'll say this, I don't know, I'm probably in our 15th year or so of creating a balance sheet for our own farm. And every year there's one little thing that I think of, gosh, I've never included that before. So what I would really encourage you to do, Robin and I, part of our main goal for this whole entire series is to give you tools that you can use to be workable tools that you can use and implement on your own farm. So what I'd encourage you to do is, if it's your first time of creating a balance sheet, do your best. Try to take these notes and do your best on getting the information in there. But I guarantee if next year, if you come back here in January and you make your balance sheet again next year, you're gonna think of things that you hadn't thought of before. So focus on completeness, but do your best for the first time. So we want to make sure that we account for all inventories. We want to, accounts receivables and accounts payables, sometimes those are a little tricky. Sometimes things that are common that people forget when I'm talking with them is they might forget about something outstanding at their ag retailer, or they might forget about that they have a credit card balance outstanding. They just don't think about it because it maybe isn't the normal categories. So try to remember everything, but again, start somewhere. That's better than anything. Also, those accrued income and expense items. I think accrued interest is, especially those first few times that you do it, that's a little tricky to remember to do. And focus on accuracy. The more that you do it and the better job that you do of including everything, the better assessment tool that it's going to be for you to be able to know what your financial position is. So I do want to share with you something that part of the reason that I think that having the balance sheet is really important. And when I work with a farm family, I really kind of harp on them a little bit of making sure that spouses do the balance sheet together and that they each know. And I'm going to just tell you a story of I have somebody who's very close to me who lost their spouse unexpectedly not too long ago, about a year ago or so. And the reality was, in that situation, I mean, it's obviously a terrible situation. There's a lot of emotions and everything else. And there were assets that the spouse that was remaining didn't have any idea what the value was of those assets. So I really encourage people working towards doing a good job of recording all of the assets and all of the liabilities. One, so that you can have a balance sheet that's a good tool for your farm. But secondly, it's something for each of the spouses to know what are the assets and what are the liabilities. And what are all those pieces? So instead of saying on our farm we have $1 million worth of machinery, list out those items of machinery that get up to that total amount, so that you have a good inventory list of what they are and what they're worth. Sometimes I see people who don't know about the machinery, what the various pieces are. Another common one that I see is maybe there's some 401ks or some investments or some life insurance that the other spouse doesn't know about. But the balance sheet is a good way that you can have all of those assets and liabilities listed in one place, so either spouse will know what those are at any time. So that's just something I really want you to think about as you're doing this going forward. So some other pieces, and I alluded to this one a little bit before, is keeping underlying schedules for the various pieces that are listed on your balance sheet. So for example, inputs or prepaid supplies on hand, for example. In our example up above, it was some fertilizer, fuel, feed, seed. You add all of those items together for prepaid supplies or inputs, and it's a fairly large number, but we have a listing and a schedule behind the scenes on that of what rolls up into that number. So let's talk a little bit about completing the balance sheet and valuation. Sometimes valuation can be difficult. That is the piece that we get a lot of questions around. I like to use, and almost always when I'm creating a balance sheet with a farm, we tend to use the market value approach. Thinking about machinery in particular is what is that tractor worth today? It's a fairly easy place. It's fairly easy to find what those values are. If we go onto some of the auction websites, it's not a hard thing. We can look at any opportunity costs that are there, and just looking at the overall value of the market value, we can estimate those asset values. So the other approach that you can do is looking at the cost approach, and you can take off depreciation. That is certainly one way to do it. I will say that most of the lenders that I work with, they do prefer to see the market value. So that's the approach that I'll typically use with people. When we're completing the balance sheet example that we just gave you, we did not put any personal assets or liabilities on there because we wanted to work through that with just the farm assets and liabilities on there. But if you are a sole proprietor, meaning that your taxes are issued in just your name and your farm is just your individual name, I would encourage you to list your personal assets and liabilities. It's hard to know that sometimes which way you should go, but it will get you to the best true picture of what your overall financial position is. And it's also a good way to get all of those pieces all put together. So what are some of the things that are personal assets or liabilities? These are examples. Assets might be personal savings, stocks and bonds, retirement accounts, cash value of life insurance, not term insurance. This is just whole life or universal life insurance, what that cash value is on there. If you have term insurance, that is not listed on your balance sheet. Other high value items, some common ones that we see on a farm sometimes might be like a gun collection, jewelry, if they have some other types of collections, a personal vehicle, or personal real estate. For example, if your house is in town, not on the farm, that might be where you list your house. If you have a rental house, that's another example of personal real estate. Personal debt might be credit card debt, medical debt, Medical debt can be quite significant sometimes. That can be either outstanding hospital bills or just accounts payables to doctors and so forth as well, or loans on medical debt, student loans, personal vehicle, personal home. Like for example, if your house is separate from a farm asset, or other assets such as the rental house, if you had a rental house and had debt associated with that. So you can see there's quite a few different items that are here that can be personal assets or liabilities, and this just creates a more complete picture of what your overall financial picture is. So some of the things that we think about is, how do we grow the net worth in the business? Some of that might be contribution of cash from someplace. In my role, we always like to say, is there any way that you can have an infusion of cash? I'm not sure where. Some people don't know where that would come from. I'm not sure where I would know either, but that would be cash coming from the owners, or maybe that's an inheritance or something along those lines. Retained earnings. So that may be money that is invested back into the operation. Another way is evaluation. So a good example of this is land value changes. So obviously in the last several years, we've seen some land values increase, and this would be a place where you would capture some land value changes. One thing that we typically do on changing land values, and I think this is actually kind of the rule of thumb that Kansas Farm Management Association uses, is we don't do land value changes typically. We normally do not adjust those every single year. What we typically will do is every 5 years. So like, for example, in 2015 and then 2020, we would adjust those usually. So that's kind of a rule of thumb. And that way you don't have big switches from one year to the next. And it's very difficult to identify if those changes are real or not. But after 5 years, it's probably a pretty good indication if there's a change in land values.
Okay, going back to the interpretation and use of the balance sheet. So obviously we can look at trends across time. If you're doing a balance sheet on January 1st every year, you can look at what direction the business is going over time. So as Lavelle just covered, there's ways to increase your net worth, or that bottom line number on your balance sheet. Realized would be if you have profits on your farm business that are being invested back into the business, so your farm is growing over time. Unrealized is like what Lavelle just mentioned. If you have land that's increasing in value, that's an asset appreciation, or that is net worth change that you really didn't earn or didn't intend. It was just market value changes. And then looking at your balance sheet and saying, okay, are we consistently moving in the same direction, or are there volatile changes over time that's affecting our balance sheet? So as Lavelle mentioned, that land value really can have a big change on there. So maybe valuing that every 5 years so you don't see big fluctuations in your balance sheet because of that. Now, the structure of the balance sheet is very important. As I talked about earlier, the type of assets and type of liabilities, are they matching up? Do you have a correct number of current assets for the current liabilities that are owed? And then as your whole debt picture, how are your current assets compared, or how are your total assets compared to your total liabilities? This really affects how much collateral is available. One thing when we talk about the balance sheet, if you do a good job of putting this together, knowing what comprises your business, having details about each category, if you walk into a lender with that information and, just knowing that you are actively managing the financials of your operation and have that put together for them initially, I think a loan officer is much more willing to work with you on a bank loan just by knowing, you know, that you're managing well, you know what your picture is as far as farm financials on your balance sheet, and, you know, obviously having some collateral available there that they'll be willing to do that loan for you. Now let's go back to liquidity. Again, this was the measure of the current part of your balance sheet. So current assets divided by current liabilities. If obviously you one-to-one for sure, if this is more than $1.5 for every dollar of current liabilities, that's even stronger, or even $2 for every current dollar of current liabilities. The other measure of this is working capital. And this is the same current assets minus current liabilities, but you're subtracting them instead of dividing them. So what it does, you want this to be positive, obviously. You can compare what sources of cash you have with the needs of cash in the next 12 months. So if you have positive working capital, hopefully, you have the ability to make some decisions and do some different things on your operation. If you are in a negative working capital position, obviously you have some management decisions you have to make this business make it through another year. So working capital really should be the #1 priority on the balance sheet. We say cash is king. So this allows opportunities to be capitalized upon if you have some cash to work with. Again, current assets minus current liabilities. And if your working capital is not positive, as I showed in the example before, what do you do? So here's just a brief list of some things you want to think about if you see that on your balance sheet and you don't know how you're going to get through this next year. Refinancing of debt. As we saw in our example farm, they had a pretty poor working capital or current asset, current liability picture, but overall in debt structure, there might have been some opportunities to push some of that debt longer term. Selling of assets. There might be some assets that aren't being used, some machinery or things like that are underused that you could sell that won't affect the workings of your business, but could generate some cash. And as Lavelle mentioned before, an influx of cash or some off-farm income, inheritance, off-farm support that could be infused into the farm to help that situation. So a common question is, how much debt can my farm carry? And there's no one answer to this. It really depends on the income that's available. So are you generating enough income because of that debt to service the payments that go with it? The years to amortize, as Lavelle's going to mention in a minute here. Interest rate, typically these vary with the length of the note that we have. So how high are our interest rates on this farm? Current racial position I've talked about already. The historic income potential of this farm. Operator experience. Is there a learning curve in what you're doing? Just an example here, if you want to do a new enterprise, let's say adding turkeys to your operation, you want to build a turkey barn but have no experience in that, obviously that's going to be more risk taking on something you haven't done before. So keeping that in mind when you add debt to your operation. And then bottom line, operator health and age. As you're getting more to the retirement years, you probably don't want to carry as much debt on the farm as you do in your younger years, especially if there is some health concerns. So I want to go back to something Michael talked about last time, and this is the debt to asset ratio over time. You can see it starts in the 1970s. We had debt climb up to over 35% for a long period of time after the 1980s. But then here, more recently, that dropped back to about 20%. So 20% of the assets on the farm were owed to creditors. But you see that's coming back up now. We've had quite a few years in this ag economy that we've been adding debt relative to our assets again. And this is what she also presented. This is just what's the total debt load on our Kansas Farm Management Association farms. And you can see that has been growing over time. In 2018, it was $640,000, our average farm had for total debt. And just for some reference there, the average size farm in this data set is about 2,400 acres, with about 1,600 of those being cropland acres. So some of her conclusions too were debt has increased, obviously. The majority of the debt is increasing in current liabilities. So we're seeing a lot of lines of credit that are getting backed up and not being paid off. And 2018 was a year of increasing debt, and some intermediate liabilities, were actually getting repaid.
So yes, just to echo what Robin was just saying about the current liabilities being the place that's the place that I usually work with most often with the farms that I work with, is that current liabilities have grown. They've been unable to repay the line of credit maybe for a year or two, and then they have to do something with that structure. So oftentimes what happens is that line of credit, or a portion of that line of credit, may get refinanced into, for example, some equity in land. But as we make any of those decisions, we have to recognize, how does that impact the other pieces of the farm? Because obviously that now becomes a payment on the farm, and we have to make sure that that is going to cash flow. So if we do any type of debt refinance, are we going to be able to do we have repayment capacity on our farm? So, and if we are taking on new debt, for example, if we're going to buy a piece of machinery or buy a piece of land, will the income that is generated by that new property, will it generate enough money to make the payments? Or, for example, if you're buying land, that one piece of land may not cash flow, but do you own other land that together will the profits from those pieces of land be able to make the payments? So we have to consider whether or not we can make the situation cash flow. So when we talk about amortization, length, and interest rates, these are the most common terms that we see. Current would be a 1-year loan, like a line of credit. That'll be kind of the most common things. Intermediate being 2 to 7 years, and long-term will be 8 years or more. Oftentimes land loans are going to be somewhere between 10 and 25. You used to be able to sometimes see a 30-year loan, or sometimes with FSA loans, you might even see a 40-year loan. But with a traditional bank, a land loan often is going to be somewhere between 15 to 25 years on the repayment on it. And oftentimes the interest rate that is associated with that loan is going to be at a different rate. And it's just important to talk that through with your loan officer of what those rates will be, so that you understand, is it advantageous to do a different interest rate? But which is better? Is the longest term available? Is that one the best? Or is it best for the shortest term that your cash flow can handle? The suggestion that we typically make, and if you are longtime Dave Ramsey fans, this is a little contrary to what he usually says for a house loan. But we're talking about our farms and about probably land or machinery. We typically will suggest that people get the longest term available. And then if they have the opportunity in positive years to make a little bit of a prepayment on that, then that's a good place to be at. But if we're in lean years, like we've been in the last couple of years, sometimes those years you can only make that minimum amount. And we want to have enough space to be able to continue to make all of our other payments, and not to get everything backed up on top of each other. So that is usually our suggestion, is to take the longest term available, but try to prepay ahead of time if you can, in the years that give you the opportunity to do that. So when we are looking at amortization, first we have to consider how much debt can be serviced, and that is a consideration along with our cash flow, which we are going to get into in section 4. We'll talk a little more about that. You can you know, not just your banker has access to an amortization calculator. You can Google amortization calculators. You know, a lot of ag loans are going to be semi-annual or annual payments. Just set up the amortization calculator that way. Most of the amortization calculators that are available, if you just Google something, they're mostly going to be monthly or defaulted to monthly calculators, because most people are thinking about a car or a house loan. That would be a monthly payment. But, you know, one thing we want to think about is if we look at, if you borrow $100,000 for 25 years at 6% interest, the annual payment is going to be $7,885 per year. And that seems like that is maybe something that's going to be doable within a lot of operations for that amount of money borrowed. But if we look at that and we look at over that 25 years, if you took that entire 25 years to pay off the original principal, you're going to pay that $100,000, plus you're going to have paid about $97,000 in interest. So you almost paid for that property twice. Now, our interest rates today are low, so that's not necessarily a bad thing to use that interest. But this is where we're talking about is make those terms as long as you can, but then if you have the opportunity to make some prepayments, go ahead and do that so that you can maybe cut that down to, say, for example, a 20-year payback, for example. So these are some key things that we want you to think about. When we would like you to complete a balance sheet annually, and ideally that is on January 1st. And we want you to start working towards using a balance sheet to help you to make major financial decisions. Be honest in asset valuation. Be honest in what machinery is worth. Be honest in what land is worth. If you're in a difficult financial situation where you think things are looking a little negative, still be honest in that so that you know where you're at. And then reach out to somebody like me or Kansas Ag Mediation Services that can connect you with somebody who can help you with those finances, or even reaching out to your lender so that they can help you get set on a path that can help you figure out what that situation is. Make sure to list all assets and liabilities so that you have the most complete picture that you can. And then have both spouses involved in understanding what the balance sheet details are.
Okay, we built in some time for questions here. I think we'll take about 10 minutes. So if you have a question, please tell your host agent and have them type it in the chat, and we're going to start answering those as they come in. Don't be shy. We definitely covered a lot, but I know you'll have some questions out there.
Okay. So there's a question about, is there a place, whoa, now they're coming in fast. Let's see here. Let's see here. Where to get the value of machinery and equipment other than an auction. So if a person needs help with valuation of equipment, you could also, there's a lot of different places that you can go to. You can do some research on the internet. Also, I'd encourage you to maybe work with your local equipment company. They would probably be willing to help you with that. If you need to do something for, there's also some folks that would come out and do an appraisal if it's a situation that you need to have something more than that. I think it's probably the most important piece in that is making sure that you have all of your equipment listed, start with some valuations, and then try to continue to work towards getting those more exact as you go forward.
Question here, how do you list assets on a balance sheet that are owned together with another person or business? I would recommend, your portion of what those assets are. So if it's a partnership, or you and your brother or something like that own that asset, just what percentage of that is actually yours, and just listing that amount.
Yeah, and I would probably make a note on there on a detail of, say, for example, 50% ownership in whatever. I mean, just so that you know exactly how you arrived at that number. So it's a good thing to make some notes on there.
Couple of questions here on land value. So yes, that's a hard thing to determine, without seeing some similar auctions in your area kind of thing. We do put out some values at Kansas State here at the county level, separated by irrigated, dry land, and pasture, looking at the sales that have occurred over the past year. So if you want to go on Ag Manager and look under the Kansas Land Values book, there are some starting points there, I would say, but obviously recognizing that irrigated land in a certain county is not all valued the same.
There's a question here about moving liabilities from long-term to intermediate if they go to a shorter window. No, I would recommend keeping your liabilities. So for example, if it's a land loan, keep it under long-term liability, even if you've only got say for example, 2 years left in that. Keep it against the appropriate asset so that you can compare how is my debt structure compared to my asset base in there.
One question here, how do you account for calves in a similar manner as growing crops? So calf born, not purchased, weaning calves, things like that. So you're valuing them at that day that you're doing your balance sheet. So whatever growth stage that they're in, if they're market livestock, maybe they're 600-pound calves, but you intend to feed them out to 800 or so before they get sold out to grass or something like that. You're valuing at the weight they are today, at the price that you could sell them for today, even though you don't intend to, because remember, this is the snapshot in time. So this is your picture as of January 1st of your assets on the operation. As far as growing crops, what we typically do there is look at your insurance guarantee. So on January 1st, a lot of times we have growing wheat out in the field. So what we look at is what level that wheat is insured at, what the insured price on that is, and what level insurance that you have.
There's a question here about why does my CPA always make my balance sheet? Even if you have somebody else who is making a balance sheet out for you, I encourage you to do this on your own, or you can take theirs and then use that to make your own. That you may have assets or liabilities that they don't know about. Just like I was saying before, sometimes spouses don't know about some of those assets or liabilities. So the point is to make this as complete as possible, and they may or may not know about everything that are in there.
Just a question on the financial benchmarking chart. The one I showed represented all the KFMA farms in Kansas, which is about 1,200 farms. Now, when you go to that spreadsheet on Ag Manager, you can be more selective in the region, the size of farm, and you can, make that a cohort. Cohort is what I use as the term of farms that are similar to yours. So you can get that down to a smaller number that represent a farm with your kind of enterprises and your size.
There was a question about having a health savings account and whether or not that is considered an asset. Yes, I would consider that an asset, and I would place that underneath your personal assets. But it is something that has value that you do want to recognize.
One question here we want to definitely clarify. In session 1, it was mentioned to keep personal assets separate from business assets. And now we mentioned that they should be included on the balance sheet. So what we wanted to say, yes, we should think about personal assets, because as we're looking, especially in the sole proprietorship, that can affect the collateral when we're having to make a new loan. But we want to list those separately. So you'll see in your packet there on that balance sheet spreadsheet, we have all the farm assets and liabilities. And then at the bottom, we have a spot for personal assets and personal liabilities. So you can assess the net worth of your farming operation and the debt structure there, and then assess the total picture of your farming operation and personal assets and liabilities. So we don't want them mixed within the balance sheet. We want them separated, but recognize that that personal side can have a large effect on the collateral availability in the farm business.
One other question that there was about having multiple businesses that they are managing. The way that I would probably handle that is it kind of depends on the objective. So we might want to talk that through a little bit more, but I would probably, you could do one overall, or you could do some balance sheets for each type of business and then roll that up into one overall balance sheet. That's a little more, that's a lot more complicated than what we were talking about just now. And if there's some specific questions, we can certainly talk about those after the fact. We're running close on our time. So I think we're going to break on the questions right now. If you want to continue to ask some, that's just fine. We will get the answers back on these questions to you before the next session, so that you can have a list of those questions with the answers that go along with them.
Okay, with that, we're going to give you a break from us and get you working on some of these things hands-on. So it's time to do our activity for the evening. And the goal of this activity is to give you a hands-on model that you can take home and implement this week, if you so choose. So it's going to just be basic questions. We're going to turn you loose to work on it, and then we're going to come back on to do the question and answer and go over the activity. So most of you will be working on Joe and Jean Farmer. So they operate a beef cow and cash crop operation. They're putting together their balance sheet as of January 1st, 2020, evaluating their financial position. And their farm assets and liabilities are listed separate of their personal asset and liabilities. And actually, we didn't include their personal ones on the activity you have. Now, if you look at this situation and say that doesn't really match my operation, we also have John and Jane Gardens, who own and operate Vegetable Honeybee and La Laying Hen Farm. And this is going to be one that primarily sells to vegetable CSAs, farmers markets, and restaurant and grocery stores. So at your location, you'll probably be doing the beef cow calf one, but just know the principles are the same either way. So just know that. And then the John and Jane Gardens is available for you to take home, and we have a recording of the answers for that activity as well. So just a note here, as you're looking through your packet, you want to pull out a narrative. So that has on the top, Joe and Jean Farmer and the information you did there. And then there's a balance sheet with some blanks to go along with it. So pull both of those out, as you'll need both of those for the activity. And just note, anything that's already in the balance sheet is correct. So if you're adding numbers to it, you don't need to change the totals. The totals are already correct. Feel free to work in small groups. This is an interactive time and brainstorming time as you work through this together. So we are going to break here and get back on at 7:30. So that gives you roughly 23 minutes to work through this and take a stretch and a restroom break if you need it. So we'll be going off, and we will see you at 7:30. Okay, we are back on live. You should be hearing me now. we are going to go ahead and go over the activity. Okay, so the first question that you had was an accounts receivable. Joe did some custom wheat planting that he billed for $150 and was not yet received. So that's an accounts receivable. It's something on January 1st that he did, he earned, but the check hadn't came in yet. So he puts that $150 under his accounts receivable. The next thing was some crops in inventory. So those were valued at the current market price, including corn of 10,000 bushels at $3.75 a bushel, hay on hand valued at $31,500. So when you add those up, that becomes $69,000 in crops that are held for sale and feed. So those were the two asset categories that you were able to work through there. And then on the liability side, so there was an accounts payable, there was an outstanding bill that the check had not been wrote for, and that was $10,800 for some bulldozer work. So we put that under current liabilities because we're going to have to pay that bill in the coming year, obviously, or that bulldozer will probably never come back. So you can see where that went there. And then the current portion of term debt. So we have some intermediate and long-term loans here. A bread heifer loan, a tractor loan, an air seeder loan, all intermediate liabilities, and then a long-term loan of a land loan. But we have payments that we're going to need to make on all four of those in the coming year, and the total of that is $72,019. So that goes under the current portion of term debt. Now you calculated here what is the farm net worth. So if you took the total farm assets minus the total farm liabilities, you would come up with $2,046,508. So this farm, they have roughly $2 million of assets after they pay off all of their liabilities. Now the discussion questions here. What does net worth represent? So from our presentation, obviously to calculate this is total assets minus total liabilities. If you paid off all your debt today, what would be left? And I mentioned those tax liabilities. If we did liquidate everything today, there's probably some capital gains tax that would need to be paid. But without considering that, if we paid off all of our debt, this is what we would have left. This is typically the first number that people look at when they're evaluating their balance sheet, but it doesn't give the complete picture. We talked about debt structure earlier and looking at the pieces of the balance sheet. You always want your net worth to be positive. I don't think we said that in the presentation. We kind of assume that net worth typically is positive, but there are some cases where you can get liabilities racked up more than assets and actually be backwards on your net worth. Now, for every dollar of current liabilities, how many dollars of current assets are there? This is the current ratio. On this farm, it's 95 cents. So they have 95 cents to pay every dollar of debt in the coming year that needs to be paid. So there's obviously a little bit of a shortfall here. Now, working capital, I stressed in the presentation, is a negative $10,145. What could this farm do to improve this so it's positive? They're going to need to pay their bills in the coming year. What can they do? We talked about refinancing that current debt to longer terms. So in their total asset picture that we're going to get to in a second here, they have some room to work. So they could refinance some of their line of credit or current debt to longer terms. They could sell some assets, any unused machinery, some breeding stock, some land, if it really comes down to it that we need to create some liquidity, we can sell some assets to do so. And then, as we like to call, infusion of cash from outside sources. off-farm job that can put money into the business, stocks, bonds, inheritance gifts, any way that we can pull some money outside the business and try to create some working capital and some liquidity in this balance sheet. Now, the last question, the debt to asset on this farm is 29.5. Are they in a good overall financial picture? Now, not just looking at current assets, but the whole picture. If you remember back to the benchmarking sheet, we typically think of anything less than 30 as a fairly strong financial position. But this really is dependent on age, the risk tolerance, the type of farm that it is. But overall, this is a pretty good debt to asset ratio. The biggest problem is this farm is just that their current debt is not 1-to-1 or more. They need to free up some working capital to take care of that current debt. So with that, we're hoping you're going to be looking at this in your own operation. Lavelle's going to make some announcements here. But one of the things we want to tell you, in your packet, you do have a blank version of the balance sheet. So if you want to go home and do this by hand, you have a blank version to do so. If you want to use an Excel spreadsheet on Ag Manager, there's a link there to what we call the Integrated Financial Statement tool. So you can go ahead and build your own balance sheet using those resources as well. I will bring Lavelle back in here. A couple things we did want to mention. We had a lot of questions come in via the chat and other ways, even while we were on break. We don't want to leave your questions unanswered. We do have 670 participants across 32 sites, so there is no way we're going to get through all the questions, but what we intend to do is take those and type out the answers and email them to all of you, all of the participants before the next session.
Yes, yeah, we were pretty impressed. There was no questions coming in, and then all of a sudden there were about 50 on there, so that was fantastic. We're glad that you had lots of good questions, and we'll get those out to you before the next session. We have most of the email addresses, so
you might check with your host agent that your email address is on file, but we will send that to all of you before next session. One thing we did want to address that came in, there was a question on the balance sheet example that we were using, how their checking account balance could be negative. And this is a real farm, so we are not making up these numbers. This was a real farm's balance sheet on January 1st, and what happened there is they wrote a bunch of checks at the end of the year that they did not have money for in their checking, so they're going to have to pull some money out of their line of credit to put in their checking account before those checks go through. So that is what was going on there. But yes, this is a real farm with real problems, showing the times right now and the financial stress going on out there.
Yeah, and also to mention, for those of you who are using that vegetable CSA example, if you choose to use that one, that also is a real farm that we worked with, and it's not exactly the right numbers, but it's modeled after an actual farm. So let's go on to, we have a couple of announcements that we want to get to. Next week, the financial topic will be about income statements, and the local topic will be family living expenses. So that's what's going to be coming up next week. We will be focusing on those family living expenses and having a local topic on that next week. So we want you to continue to track your family living expenses this week. Hopefully you did that between now and last week, and we'd like to see you have 2 weeks worth of information to work with. So again, you have this family tracking sheet in your material, and just keep adding to it. The other thing is we also have that personal action plan that we want you to continue to add to every single week. So for example, tonight, you might choose an idea that you would want to implement before next week's session. So an example might be, I will complete a balance sheet for our farm before next week's session. That would be one example that you could do. And then choose 2 other action items and a timeline that you might want to accomplish. A couple of examples might be going to agmanager.info and downloading that benchmarking tool. That is a wonderful resource to kind of get an idea of where your farm lines up. So I highly encourage you to do that. And maybe one of the benchmarking ratios that you want to look at is that debt to asset ratio would be a great one to look at. This again is what your personal action plan is. We want you to note 3 takeaway messages that you felt were really resonated with you tonight, and then complete those My Action Plan and your timeline. And if there is anything we forgot to mention, we really appreciate that feedback. And if you have other comments as well, that is very, very helpful. So once again, we do want to recognize our sponsors for this. North Central Extension Risk Management Education is a grant that we received to be able to provide this education, and we really appreciate those resources. And then we also have statewide sponsors from Farm Credit Associations of Kansas and Central National Bank, and then multiple local sponsors as well. So we do want to recognize all of our sponsors who have helped put this on. So if you have any questions, our information is here. And now we are going to switch over to the local topic. How this is going to work this evening is there's going to be about a 15-minute presentation from campus from Elaine, who is here on campus. And she's going to talk about some things around how the stress around agriculture, how it's a little bit different type of stress than the usual stress that we have. And then you guys are going to break into a local discussion about some of those topics. So we are going to switch, and here comes Elaine.
Thank you, Lavelle, Robin, thank you. I will come in. I hope my green doesn't clash with our purple. Wow. I should have gotten with the cue and worn something like a purple and white. Well, thank you. And thank you for inviting me to join the group this evening. And I want to thank all the people out in the field, the facilitators, the co-facilitators, the participants, everybody. Everybody's out there. And I'm so grateful that we didn't have the terrible snow and blasts that were expected. So yes, Elaine Johannes is my name. I'm an extension specialist over in Justin Hall. For those of you who've maybe been here at K-State, I am a family and youth development specialist. I'm over on the consumer science side of the house, and I've actually been with Extension for, heavens, guys, about 28 years. God. Saline is home for me. Kansas is home, and Kansas is where I want to stay. I wasn't raised on a farm, but I had relatives in Smolin and Solomon and thereabouts that did dairy, that did production ag. And so when I came to K-State University back in 91, I was given the opportunity to manage the Rural Mental Health Grant. And at that time, that was what we were calling the farm stress response. The Department of Agriculture, through Farm Bill funding, funded about 9 states, Kansas was part of that, to respond to the farm stress at that time. And some of you out in the field now, in your groups tonight, remember that. Some of you remember maybe how your parents responded, maybe even how your grandparents, and maybe you recall the stories about how the community worked together and how we worked with faith community, we worked with mental health folks, we worked with schools, and Extension led that way. So I'd like to spend some moments this evening talking a little bit about the different stress that's happening now. And I want to compliment the facilitators right there in your groups tonight. We've been having some discussions these last 2 weeks to talk about how do we want to discuss stress tonight, and what is the goal of the time we have to talk about it. And what I would suggest a goal being, you guys out there are learning a lot about family, about the financial parts of your family, about the strengths you have. And I bet you at the end of the series, you're going to also know the strengths of your community. So what I would recommend in the time we have this evening is thinking about yourself as a learner, but also as a leader and a listener. If you could listen to what's going on in the community, what's going on out on the farms, the ranches, what's happening up and down Main Street, and also be willing to share that. Our facilitators who are helping tonight are going to want you to think about the resources that your community already has to address stress, farm-related stress, agricultural-related stress, and family stress. They're going to want you to kind of share what you already know, but also to brainstorm. And so I've asked them before you all leave tonight to come up with maybe a list of 3 things that your community might want to do to respond to farm agricultural stress. And then share that. I know that Robin and Lavelle and I and everybody who's been working on this series want to hear from you. We do want to collect the resources that you're going to brainstorm this evening, and we want to share those. Actually, before we get into my talk, I want to share with Lavelle, Robin, and do a shout out for Andrea Burns from Ford County. Andrea, if you're out there, I actually got your compass material today. There's some really excellent helps. Oh, there I am. Excellent helps already, and some excellent material that actually our partners in mental health have created. An example of what might be happening out in the community to provide support. Now, another resource that I got was actually, it's in development now. This is from the Manhattan Commission. It's the sale barn. This is a sale barn card. Most of you know this better than I. And on this side is some good information. But boy, we could put information on this side about some helpful hints on how to cope, how to deal with stress. So again, good ideas. So enough about me. Let's talk about what we're doing this evening. Right now, I think all of you are aware that there are some everyday life stressors. I think this little graphic portrays it pretty well. That blue is just everyday stress and the things that I think most producers, most farm households are prepared for. And then that purpley area is what we're calling secondary stress. I'll talk a little bit more about that. Actually, it's that secondary stress that can pile up, and we want to acknowledge that, and we want to acknowledge it in such a way that the community, that those in the room tonight and those across the state are building supports for coping and mastery, feeling like we can handle this. Now, what we're wanting to avoid is that spillover, that stuff that's coming out that can create detriment, that can create harm, that can harm our health, physical health, and also mental health. You know, back in 90, 91, on off, we learned a lot. We learned about how to work against the spillover, and we could only do that by equipping our mental health providers in the communities that, so they understood rural and they understood ag stress. We also are learning now. So my remarks this evening and the materials that your facilitators have are really based upon what we're learning and what we did gain from those early farm stress concerns and what the research does show. Robin's helping me with his slides, so that's great. I'll just use that one too. So right now, I imagine you've been here all evening and you are aware of some of those primary stressors around the farm industry, around agriculture, around just living out in rural areas. The weather, physically hard work, you know, equipments fail, seems like all the time. there's just lack of time to get all the work done. And then the distance between just getting back into town or getting business done, the cost of goods, prices are low. Those are the primary stressors that I think most of our producers and the families, the people who care, are prepared for. But what probably we aren't acknowledging, and probably maybe it's in the back of your mind tonight, are the things that are adding on. And these are the things that we learned about in the 1990s and beyond that can actually weigh on an individual and create a spillover. So what are some of those secondary stressors that you might be aware of? Our producers may have blurred roles. Not only are they on the farm site, ranching, producing, taking care of that part of their industry, but they might also be working in town, having multiple roles, jobs. One of the jobs may actually be to be a helper with others. Maybe they're a pastor, a minister of a church, teacher in a school, working at the bank, grocery store folks listen also. The listeners of the community that are listening to the stress and the concerns, and in the back of their minds, they know they're having the same issues, but they don't feel they can share it. Their roles can get blurry. Then just regular life changes. As we get older, sometimes our ability to do that physically hard work is strained. As we get older, sometimes our goals change, how we dig in deep. Maybe we're motivated by different things other than just working out on the tractor again. And maybe also we want to retire. Maybe there's a hope that somebody will take over the place and we don't have to worry about it. But what if we haven't had a succession plan, or maybe no one's wanting it, or heavens, what if somebody wants it that's not from the area, they're out of state, and they don't have any intent to farm anyway? All of these changes then that can also lead to worry, anticipatory stress, thinking about the trade, the agreements, will they be of help? Will they actually pan out? What will happen in the next iteration of the Farm Bill? Or what about this loan or the payouts? That anticipatory stress and worry diminishes our ability to bounce back. And also it can change how we feel about ourselves, our identities. In Kansas, as are in most Midwest states, our producers are male, mature males, who have an identity with farming, with the agriculture industry. That's their identity. And if that's at risk, then maybe they begin to question their worthiness. Do they belong in that community? And that can create that spillover. And the spillover, if we aren't acknowledging it and sharing that with the community, can lead to anxiety, anger, feeling depressed. Now, before we move to the next slide, I take a breath, get a kind of a gauge on how are you doing tonight. When you're done this evening, you will feel community. You will feel listened to, and you'll be part of a team. And then you'll come back for session 3 and 4 and continue to get that support. So as you're thinking about yourself, I want you to share what we're learning with the people still at home, still at work, and the people that you'll run into tomorrow. Because what we learned in the 90s is that farm stress is not one person's fault. There is no shame around it, and it truly demands a community response. Golly, how do you raise a barn? You know, you don't do it alone. You get a whole community and you work together. Now, true, we do have mental health agencies, providers across the whole state, but sometimes they aren't easily accessible. So as we're talking about stress, I'd like you to think about what can the community do to maybe help us in the long haul And if somebody does need mental health help, get them that help, but it may take a little doing to get them there. So what can we do in the community? 3 things. First thing, social support. Make sure that that person or the family know that they belong, they matter, that they are part of community. Now there are a few barriers we need to be aware of, and some of the research that has been done in this United States and actually Australia has shown that some of the barriers to creating a way for people to share their stress is sometimes we don't listen very well. Sometimes we belittle what the problem is. We judge somebody for feeling stressed. Maybe you've heard it yourself that some people minimize how people feel. Well, that's a barrier that doesn't help people feel community. One of the other barriers is jumping in with inappropriate advice. We saw that earlier in the farm stress issues, and we're seeing it now. Sometimes people don't know what they don't know. If we have people who don't understand the farm economy, don't understand the stress of the job, they can provide advice that's not relevant and actually shuts down the opportunity for people to be heard. How about number 3, litany? This can happen, in the coffee shop or down on Main Street or even in our own households. We look at your problems and my problems are worse and my list is longer than yours. And, that's not helpful. That doesn't build community and that doesn't affirm that people belong. That last sentence there, some of the research that has been done in Australia around farm stress shows that the people closest to us may not actually be the people who we can actually get help from. Roy has reported, according to some studies, that wives report their husbands are sometimes sullenly quiet about the problems they face. In the same study, husbands interpreted offers of support as an affront to their ability. So like 2 ships in the night, that we would hope that they could provide support, there's barrier. So it's important for community to be there to support the people most invested in the farm, the ranch, the industry, to help them as they're trying to help the people in that household. What else can we do? Well, in social support, we affirm that people can cope. Farm stress, agriculture-related stress, is part of the industry, the calling that farmers have. Now, it's difficult now when we add on so many of these additional stressors and the secondary stressors, but remind people, how have they coped before and how have they bounced back? 1990, 1991 and on, people realized that they weren't alone and that they had gone through some difficulty and they learned from bouncing back. So encourage people to think about, maybe even through this statement, what coping skills have you used before that has helped you and that has helped us as a family, as a community to bounce back? That also leads to the person feeling masterful, that they know things. They aren't frail, they are brave. The courage that somebody has to acknowledge that they can't do this alone, nor should they. The courage that somebody has to ask for help, and especially if they're having some stress responses that show that they've spilled over, that they really do need some respite, some professional assistance. That's a courageous act. Again, from Roy, our colleague in Australia, has reported that males especially, if they can kind of switch that change in their brain from asking for help as a sign of being weak to a sign of being brave, that's what we want to affirm. And then finally, we want to celebrate agriculture, celebrate the industry, and celebrate why Kansas is here. We are an agricultural state. The producers have beliefs that they understand the environment, they understand the world, and they understand how it's organized. We need to celebrate that. Some of the facilitators know that I've told this story before. Around 1991, 92, we had farm town halls, and we would go out in the state and listen, and there were a couple of times, it was wonderful, that people that actually owned a local hotel would say, you know what, let's have a weekend. Hey, if any of the wives or any of the other households wanted to come over, spend a weekend, don't have to pay for it, enjoy the indoor pool, and breathe. Have some time to feel welcomed. The community would celebrate and acknowledge that they aren't alone. So we can still do that. We can still deal with the potential of spillover. And I don't want to leave you without acknowledging that sometimes we do feel that we are at our wits' end. So some signs that maybe your facilitators will talk about tonight. Now, we aren't going to stay on them, but I do want you to know that if some of your producers, some of the people in your households are having changes of how they feel, their emotions flare. Now, true, all of us are, sometimes at our wits' end. But I want you to put that on the list of things to be aware of. Maybe you yourself are having changes in your attitudes. Maybe you yourself are having just memory issues. Yes, that's part of just maybe having too much on our minds, and it's also part of maybe too much stress. Changes in behavior, consistently changes in behavior. Consistency with attitude change, emotional flares can actually be representative of somebody who's about ready to spill over. And then finally, those that do pay really close attention to how are we doing out in the fields and out in the stock yards, changes in the industry and how we keep it going in our own households, in our own farmsteads. Those changes, coupled with the constant stress and coupled with the fact that maybe the community doesn't have a response that's helpful, can create a spillover. So I thank you all so much. I thank you being there tonight. I thank Lavelle and Robin for inviting me. And carry on as a team. So now I think what will happen is your facilitators will lead a conversation about resources, about if anything that I've mentioned has hit a nerve or hit an idea. We're with you. You are not alone tonight or after tonight. So I'll turn this over back to Lavelle, Robin, and I thank you all. And we'll be in touch.
Okay, so we're going to turn this over to you at your locations to have a continued conversation. And we are going to sign off from campus now, and we will see you next week. Thank you.